Hello everyone. I am introducing you guys to two AM session models that I utilize, beginning with the AM reversal model and then separately the AM continuation model. These are time-based models relating to algorithmic tendencies. The market is run by an algorithm, and the algorithm has a tendency to perform certain things repeatedly in the market. I will go over the terminology, the requirements, and the steps necessary to succeed with these models. So without further ado, let's get into it. So the AM reversal model. I will be giving an in-depth analysis of this highly efficient model. So this is a rough sketch of what the model roughly looks like. I will be going into more detail in the following slides, but as you can see, the AM reversal model consists of price sweeping one side of liquidity and distributing to the other side, targeting opposing liquidity levels. The AM reversal model directly opposes retail logic. It opposes the flawed conception of support and resistance. Retail traders, retail concepts, retail logic is based upon concepts like support and resistance. And these are flawed concepts. I will reveal why in following slides with comparison to our logic to show you the difference. If you are new here, new to these concepts, new to this model, I want you to refresh your mind and reframe it on how you view the markets. Forget all the retail logic you've been taught. Think in terms of how the algorithm will fool retail concepts. The algorithm is brutally designed to terminate retail traders. Knowing this, think in terms of how the algorithm will operate and how it will terminate these traders and how you can take advantage of it. Now, before I get into the model, you hear this all the time. Buy side liquidity, sell side liquidity, liquidity, so on and so forth. What is liquidity? I tried to give you the most simple, dumbed down, easy to assimilate definition of what liquidity is. And so I formed it with liquidity being areas on the chart where retail stop losses are likely situated. Support levels with retail concepts, resistance levels. Stop losses, retail stop losses are likely situated above resistance, below support. The algorithm knows this, and so the algorithm has a tendency to target these areas before making its intended move. In the image provided below, you can see the long line at the top of the image. Retail traders see that as resistance, but price goes through it, sweeping that liquidity before distributing lower. This contradicts retail logic, and I will get into why it does so. Here, I have a side-by-side, the same exact picture, side by side, on what retail sees versus what we see, and how they differ. Starting with retail logic. Retail sees that red line as resistance, meaning it is an area where price will resist and reject lower. So they go short when price retests that resistance level, and they put their stop loss above. What they will see is price went through the resistance and stopped them out. According to their logic, resistance flips into support when it's disrespected, and upon the retest of that resistance level, now deemed support, they will go long. And price distributes lower right through it, stopping them out again, making its intended move, targeting opposing liquidity. As it comes down, it comes to the support level, their logic tells them to go long. Price disrespects that support, stops them out. Support flips into resistance according to their logic. They will go short upon the retest. But what happens? Price reverses, disrespects the level once again, and distributes higher, making its intended move. As you can see, retail concepts are not professional and outdated in the sense that they do not work. Now, let's go over to our side. What do we see? Well, to them, that is their basis of their trade. To us, that is just step one to our trade. Step one in the requirements for our trade. When price goes up to that black line on our image, we see that as buy side liquidity. We wait for price to go to it and through it, and wait for price to reverse. And upon that reversal, we look to go short, targeting opposing liquidity. We catch that distribution lower. We see that price sweeps the lower black line as well, that one being called sell side liquidity. Price goes to and through it, as we expected, reverses, and we look for our entry to go higher, targeting opposing liquidity and imbalances. So, back to the AM reversal model. Here are the requirements. Before you ever look at the chart, time is the most important factor. Specifically for this model, between 9 and 11 Eastern Standard Time, which is New York local time. When you're in this window, then you look at your charts and look for the following to be met. The first step, as I've stated, is a sweep of liquidity. Price to go to liquidity and through it before reversing. Then, once that occurs, you move on to step 2. Step 2 is optional. Step 2 is not always there, but if it's there, you take it into account. It adds more confluence to the trade. If it's sweeping sell side liquidity, which is lower liquidity, you look for a 15-minute bullish fair value gap to be situated below the liquidity it is sweeping. If price sweeps buy side liquidity, which is liquidity higher, you look for a 15-minute bearish fair value gap to be situated above the liquidity. It may seem a bit complicated right now. I will be giving you images in the following slides to help you. If step 2 is not there, if there is no higher time frame fair value gap, you just wait for price to sweep liquidity and reverse. Then you head to the lower time frame and look for the reversal, price to come back above the liquidity it swept if it's sell side liquidity, or back below the liquidity it swept if it's buy side liquidity. You wait for a break of structure, and then your PD array entry, targeting opposing liquidity and imbalances. Don't worry, I will be giving much more detail consisting this model. So, AM reversal trade example number 1. This one is including step 2 with the 15-minute fair value gap. So what does it look like? Here, price goes to buy side liquidity, sweeping it, and as you can see right above the buy side liquidity it's sweeping, there is a higher time frame, 15-minute bearish fair value gap located. You wait for price to go through the buy side liquidity and see if price rejects that higher time frame bearish fair value gap. This will likely engineer the reversal. Once this occurs and you see price beginning to reverse, that is when you head to the lower time frame for further requirements and your entry. Now, what do you target? There are 4 targets. that you can utilize. 15-minute equal highs and lows, 15-minute single high, single low, 15-minute data high, data low, and 5-minute equal highs and equal lows. Now, most of the time, 15-minute equal highs and lows, 15-minute single high and low, and 5-minute equal highs and lows will be the ones you utilize. The 15-minute data high and low is specific for certain news event days, which I will be providing in another video. So, in this specific example, there are 5-minute relative equal lows below. That is what you are targeting. You wait for the reversal. You head to the lower time frame. Price came back below the buy side liquidity it was sweeping. You can see on the 15-minute time frame, it respected that bearish fair value gap. It broke structure and formed a fair value gap as well. You wait for price to retest that fair value gap before entering. Then, upon your entry, you put your stop at the swing high and you target the opposing liquidity. This one being the 5-minute equal lows. Along the way, there will be opposing liquidity and imbalances that you can take partials at as well. This trade went for 100 points to the 5-minute equal lows. Now, I chose this trade purposefully because you can see that price disrespected the fair value gap we entered upon. That does not mean you collapse the trade. Many times it happens where price will disrespect that initial PD array you enter upon and still head to your take profit levels. This is another example of it. Price went through the PD array we entered upon and still dumped to our target. Once you enter, you set your levels, you don't touch a thing after. So let's go to AM reversal trade example number 2. This one is not including step 2 in our requirements. This is without the 15-minute fair value gap. As you can see, price goes to it and through buy side liquidity. Here, you wait to see a reversal, price to come back below buy side liquidity it swept, break structure, and form the PD array. You can see there are 2 sell side liquidity levels, which is single lows that we are targeting. The first one being take profit 1, where we take partials. The second one being take profit 2. As you can see, price comes to it, reverses, breaks structure, breaks a short-term swing low, forms a fair value gap to enter on, and you enter upon the retest of the fair value gap. Put your stop above the swing high, scaling profits at that take profit level, which is the first sell side liquidity level, and you're out full at that second sell side liquidity level. Now, as you can see, when you enter the trade, you face little to no drawdown. Price goes 145 points straight down to sell side liquidity. Along the way, price respected the bearish PD arrays throughout the trade. That is what you want to see. You want to see price disrespect opposing PD arrays and respect PD arrays in your favor. You can see along the trade, several fair value gaps formed, and they were respected. So that is the AM reversal model. You have examples with the higher time frame fair value gap and without the higher time frame fair value gap. Both are probable, both are applicable, and both are highly successful. So thank you.